please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This is Bazaar Morning Call, live from the CNBC TV18 headquarters in Mumbai.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me Anuj and Sonia, refreshed after the weekend. Well, the markets don't look like have got too much of very good cues. It's certainly a market of two halves. There is the IT sector and perhaps private banks with excellent numbers coming in from both Indiabulls and HDFC Bank. There's nothing wrong with that part of the market, but the other part, the macros part, perhaps could continue to belabor, like we saw the Bank Nifty struggle on Friday. I wouldn't be surprised if that continued because we've got everything going against them. US bond yields almost touching 3%, dollar stronger over 90.5 at this juncture, the dollar index that is, and of course higher crude prices. That's a horrible combination. Normally a strong dollar brings down crude prices because it's denominated in dollars. Today we have both things against India, so to speak. Almost $74 on Brent and the dollar index going at 90.4. Therefore, there will be that part of the market that will struggle. The Indian bond markets are also broken, but I'll come to that in a bit. That's where the negativity comes. But yes, IT is there to take us there.
Oh, absolutely. And, we saw big delivery-based buying in names like TCS, right? Lata, morning. Anuj, morning. I take your point about the US bond yields. Everyone's talking about that globally as to how, now rates could be hiked more aggressively this year and how perhaps bonds could be a more compelling investment than equities. But, of course, that, remains to be seen. For now, let's discuss this week and how to approach it. Anuj, morning. You've been saying for the last many months that IT is a sector that could take leadership. And that's what's taken place. We saw huge buying on TCS on Friday. But do you think now the support that we get from IT is enough to offset the fall that we've seen in the other sectors?
Yeah, morning, Sonia. 1,000 crores of delivery buying in TCS. 1,000 crores.
Not a joke.
It's not a small amount. And 850 crores of delivery-based buying in Infosys. So these two stocks accounted for 1850 crores of delivery-based buying. And of course, my sense is that most of this would be backed by institutions. So that, of course, is the part where, you have a huge amount of buying taking place. 1,000 crores in TCS and another 850 crores is what we had in Infosys. What has now happened is that the financials weight is down to 35% from peak of 42%. We were discussing this last year that 42% was unsustainable, and IT's weight has gone up from 8% to 13%. And the benefit of that was seen on Friday, because on Friday TCS and Infosys contributed 50 points to Nifty. It ended flat, but 50 points came on account of TCS and Infosys. And when was the last time you saw Bank Nifty down 200 points and still Nifty being flat? And that was the power of this buying that you saw from TCS and Infosys. In fact, this year the IT index has outperformed the Bank Nifty by 22%. So perhaps in the near term, it got overdone on Friday, so there's some bit of reversal. But that big trend is intact, that IT is your big leader, at least for now. Also, last time when the US was raising rates and crude oil prices were rising, India was going through its biggest bull market. So, I mean, of course, I'm not saying that same thing will repeat. But as of now, the market's texture and this is expiry week as well, is still not broken. Even on Friday, if you bought that dip, ultimately you made money by the end of the day. The Nifty actually ended at the higher point. There is a big resistance at 10,600 now, so you got to watch out for that. And for the Bank Nifty, now the support is between the 20 and 50-day moving average, 24,750 to 24,880. My sense is that you should try, and this is an anti-consensus call for now, you should, even though there could be some pressure because of crude and bond yield, you should try a long trade. You observe the first hour, see the low that the Nifty and the Bank Nifty make, similar to, like we discussed on Friday as well. Put a stop, say, of that low and somewhere around 20-30 points and try a long trade, because this is expiry week and the series has been good. So buying the dips has worked. If the Nifty,
why would you say that's an anti-consensus trade? Because the buy on dip strategy has worked so far, right?
Has worked so far, but today morning, first of all, for starters, I don't believe the SGX rate, because for last 3 or 4 days it's been getting it, horribly wrong. Because a bit of a consensus emerging that 10,600 has now become triple top and ceiling. Okay. And so I still don't believe that. I still believe that maybe there's one more round of buying which is left in the market for this series. May could be different because May you have a lot of cues, but If the Nifty does not break 10,500 on the way down, then chances of a 10,700 expiry still remain, and that's where you perhaps may want to try a trade. If you start to break the lows of the day today and start to break 10,500 perhaps, then that theory is out of window. But for now, I think the buy on dips trade is well and truly intact with the help from IT sector.
Okay, that
Anuj, it is not an anti-consensus view. In fact, a view on what you are saying in terms of growth, the crude and the bonds not hurting is something which the Reserve Bank Governor said at the IMF speech over the weekend. He was standing in for the finance minister, and otherwise normally the speech would have been made by the finance minister. It's an extremely bullish speech on growth, and normally RBI governors don't speak like that. So, you know, unless they're damn sure that growth is intact. Now, I'll tell you where the bond negative news could be overcome by the growth news. Normally, we get higher bond yields, higher crude. All this is negative for India. But along with it comes global growth. Why is crude doing so well? Because global growth, the demand is so strong. And that is why you saw a TCS with double-digit growth. You know, it can be seen, our export-oriented sectors, like, say, a Mindtree or a Cyient. Okay, Infosys isn't yet there, but that's an Infosys problem. All global-facing sectors are doing well. They are telling you that they are taking advantage of global growth. And that is why a higher crude price will be managed by the economy, because other sectors like IT will bring in more exports. So you're absolutely right that, you know, there is enough in the global positivity, in the global growth to help us transcend the 10,000. I, for one, won't be surprised. Growth impulses are genuinely strong. But separately, we have a dislocation. And that is the bond market. So my worry is quite crude and bond markets are going to be a near-term negative because we have no buyers. And I can tell you the confusion in the bond market. The short-term bond yield, 1 to 4, which was what the market was asking, that devolved on Friday. No buyers for the short-term bond. That's pretty shocking. Everyone thought that the FPIs are buying a lot because you saw the yields fall a goodish bit on Friday. They fell from 7.78 to 7.68. It was a very good rally in the bond market because the news was somebody is buying. Now the FPI number, they did buy long bonds, but they've also sold a lot of short. So the net number is negative. Then there was one theory going in the markets that RBI may be buying. Now you get RBI's numbers with a lag. The previous week's numbers show no buying. Now, this week's numbers, we will have to see. We will get it only next week. But I don't know how the markets are going to take it. Today, the markets have every reason to feel a little low. Because the bond auction devolved. The state government loan auction for this week is higher than they expected. Crude is at 74. US yields are at 3. They've really no reason to cheer at this point in time. So that negativity will continue. But I have no doubt that growth sectors can, pole vault us beyond current resistances.
Okay, also this is a very, very important week as far as earnings are concerned. So a lot of big numbers coming out this week. From the banking space, you have Axis Bank, Yes Bank that report their numbers on Thursday. On Friday, you have Reliance Industries, Maruti that reports its numbers. So it's going to be a pretty hectic week in terms of earnings. And tomorrow, you have names like Bharti Airtel, etc. Well, action-packed day and week lined up. Let's tell you what our wise experts have to say as we head into trade this Monday morning. Kenneth Chan of Jefferies is a wise man today. He says, over the past week, global equity ETFs saw a moderate inflow of $4.4 billion. Emerging market ETFs with an inflow of $2.5 billion outpaced developed market ETFs, which received $1.9 billion. Okay, that's interesting. The latter was hurt by solid withdrawals in Japan and Europe. Chan adds that while the latest Japan ETF liquidation was significant, their findings suggested that this might not necessarily be a bearish sign for the equity market. Overall inflows into APAC equities continue.
All right, and now for another equity call from Mahesh Nandurkar of CLSA. Nandurkar says oil is now firmly above $70 a barrel and there is talk of it moving to $80. This, he says, could further damage investor sentiment as the economy does not have a lot of cushion, especially in a pre-election year. The twin deficits issue could re-emerge with the current account deficit moving up to 3% of GDP and fiscal risks to the tune of 40 to 50 basis points of GDP. Mahesh adds that a weak US dollar and strong RBI reserves would limit the currency impact, but the era of rock-like stable rupee may be behind us. Well, I just want to add, I don't have it handy and I didn't see this Mahesh Nandurkar comment, but I had a debate exactly on this on Friday, and you know, this theory was debunked. They don't expect. I had Ashima Goyal, I mean, a very respected economist in the PMEAC. I had Sajid Chinoy, a normally conservative economist, and Neeraj Gambhir, and nobody thought current account deficit is going to 3%. For exactly the reasons I told you. That global growth is good and therefore export-facing companies are going to get us the dollars. So I wouldn't believe Mahesh Nandurkar. At least many people don't believe.
Okay, but the rupee in any case has been in a free fall of sorts. I mean, on Friday, the rupee hit, what, a 13-month low. It's trading now well above that 66 to the dollar mark. So everyone's talking about that. Let's get you some money market views as well, how to approach it today. Pramit Brahmavat of Veracity says that higher crude oil prices and a stronger dollar are continuously putting pressure on the Indian rupee, thus by depreciating the rupee. Pramit expects that the rupee may depreciate till the 66.20 mark and therefore sees a trading range of 65.80 to 66.20 against the dollar today.
66.12 when we went to bed on Friday. So 66.20 is not a tall ask at all. Well, on bonds, Ajay Mangludia of Edelweiss says bond market sentiment is unlikely to improve after the partial auction devolvement on Friday and with the US 10-year bond yield fast approaching the 3% mark. He adds that crude prices remain elevated and will be the key influencer for yield trajectory. Negative bias is expected to persist at the beginning of the week, but activity may be subdued. Ajay expects the yield on the 10-year bond benchmark bond yield to trade in a range of 7.7 to 7.78 today.
Okay, over to Mangalam then for the world view.
Well, Wall Street was pressured on Friday. The Dow down about 200 points on account of Apple, which was down 4% in trade on Friday. The S&P 500 too fell below its 50-day moving average. So Apple, the key drag, that stock ended 4% lower as Morgan Stanley says that their June iPhone sales is likely to disappoint the street. Apple's downtick actually offset GE's uptick. That stock was up 4% as the company's quarterly earnings and revenues beat estimates. What actually took place was the 10-year yield. That one was at a 4-year high, and the 2-year yield was actually at a decade high. Crude oil at 74. Donald Trump pulled out his phone and tweeted about crude oil as well, saying looks like OPEC is at it all over again with record amounts of oil all over the place and fully loaded ships at the sea. Oil prices are artificially very high and this will not be accepted. But across the Atlantic, we saw a large amount of cuts across the European region as well, by and large lower. And the only stock that stood out there was Ericsson, which was up about 18% on account of good numbers. Asian markets are lower, taking the cues coming in from Wall Street and ignoring the sort of peace pipe that was blown between Kim Jong-un and as well as Donald Trump. So Donald Trump earlier on Kim Jong-un's message said that progress has been made for all. However, then came another tweet saying that we're a long way from conclusion on North Korea. Maybe things will work out, maybe they won't, but only time will tell. So we'll keep an eye out on that. As of now, the SGX Nifty on the back of weak Asian cues indicating a start lower in today's session.
Okay, thank you very much for putting all those cues. SGX starting on a negative note, but as Anuj said, it's not been a very good indicator. But we have so many global cues, all interrelated, of course, the rise in US yields, the rise in the dollar itself, and separately, crude rising despite the dollar being strong. Paul Kitney, the chief equity strategist at Daiwa Capital Markets, has joined us to make sense of all these trends and factors. Paul, good morning and thank you very much for joining us today. How much should an emerging market investor worry with dollar now over 90, 90.4 and US yields touching 3?
Yes, good morning. So, yes, I think finally we're starting to see the dollar reflecting the moves in the Fed that we've seen over the past few months. So what has been very interesting and slightly bizarre is that since we've seen this move off the zero lower bound for the Fed funds rate from December of 2015, is that the dollar and the Fed have been in unison until about 2-3 months ago where we started to see them diverge. So I think they diverged largely due to the fact that I guess markets knew that there was going to be an increase in the supply of treasuries coming on due to the deficit finance tax cuts. So we probably saw China and Japan in particular holding back on their purchases, which led to that weakness in the US dollar. Now that bond yields in the US have now approaching the year's high near 3%. In fact, today I think we're around 2.96% on the 10-year bond yield. The yield differential is now starting to favor the US dollar, and now we've got the Fed and the dollar back in sync. This is actually quite natural. So a lot of the so-called weakness we were seeing in some of the cross rates across the region, including in India, are more reflective of strong dollar dynamics rather than sort of weak local currency dynamics. But overall, I don't see it as being an issue.
So, Paul, good morning. How do you approach the equity markets then? Do you think higher yielding bonds could be a more compelling investment compared to equities for the rest of the year?
That's a great question. So I've done some work on this in particular, and so we've looked at this. We've looked at this in general for equity markets. You know, we have to bear in mind that we've only actually been out of deflation in the United States for about 18 months. So bond yields and inflation expectations in the U.S. is represented by the 5-year break-even inflation rate, bottomed in June of 2016 at around 1.5 and 1.4% respectively. So we've only actually been, a bit over 18 months out of deflation. Now, we don't go immediately from a deflationary environment immediately into an overheated inflationary environment. We have reflation in the meantime, which is where you've got positive real growth. So a little bit of inflation following deflation is actually pro-growth. And so long as you've got real growth growing faster than the increases in the cost of capital is represented by the increase in bond yields, then this can actually imply a higher PE multiple. Now, so long as bond yields, based on my work, stay below 4%, then this area is actually constructive for equities. Now, so long as the US dollar doesn't get very strong, in fact, a gradual policy normalization is consistent, which is my base case, which is, 4 hikes over the course of the next 12 months, or a Fed funds rate of around 2.5, 2.75% around a year from now, is consistent with, at worst, a mild appreciation in the US dollar. So if we take together strong trade cycles, strong commodities, and emerging market valuation discount, this is positive for Asia EM in the region. So overall, I actually think it's quite positive.
Okay, how would you look at India then, Paul? I mean, a slight problem in the sense that we are approaching a higher current account deficit than we had in the past few years. We are always victims when crude rises. So anyway, how do you look at Indian currency and therefore as a buyer of Indian equities?
Okay, so in terms of the currency, is that we're seeing weakness in again, it's sort of more dollar strength. So yes, there has been a little bit of, due to the fact that the Indian economy, domestic growth has been relatively strong, particularly strong versus China. This has led to an increase in Indian imports. And in fact, net imports have increased, which is the main driver behind the slight deterioration in the current account. So that, if anything, is the only thing that we can really sort of point to in terms of fundamentals that might potentially undermine the Indian rupee. Now, however, having said that, there's no change in the fundamentals. In fact, post-GST, post-demonetization, the returns and domestic solvency, in fact, particularly also since the capital injections into the state-run banks last October, these things taken together, the improvement in the credit rating, etc., should be a positive for FDI, which should offset those factors. So currency, I'm not too concerned about. Second thing, valuations overall are slightly overvalued versus the region. However, the macro environment is recovering very strongly. So you had bank lending growth, a bit over a year ago. It's sort of around mid-single digit. It's now back over 10%. We're seeing a recovery in consumer and corporate sentiment, and we're looking to see sort of earnings growth in 2018 outstrip most of the region. So I guess on one hand, valuations are slightly rich, but if we see earnings recover relatively fast, that will take care of the valuation premium.
But as of the week gone by, if you compare the emerging markets to developed markets, there's been more inflows into emerging markets. We just saw the data, almost $2.5 billion has come into emerging market ETFs versus less than $2 for developed markets. Do you get a sense that for the rest of the year, that could be the trend, emerging markets outperform developed?
Absolutely. So I'm very much overweight EM. I've been overweight EM for at least 6 months. And I've got even more so to believe that's the case. So I think, the main drivers are fourfold. So we've got an EM valuation discount to DM globally, which is the largest it's been in around 5 years. We've got strong commodity and trade cycles, which are not going to be undermined by trade friction, and we've got a gradual policy normalization and a benign US dollar. All these taken together, overall, are positive for EM, particularly Asian EM.
Wake up this morning to negative global cues. Most markets are still trying to digest that big surge in the US bond yields, now sitting at 3%. In fact, the Hong Kong market this morning is down almost about 230 odd points. So keep an eye out on all of that. But our own markets, what do we do today? Our research team is here to give us a list of top 10 stocks for the day. Let's start off. Anuj, what are you looking at?
So, in this market, you got to look at safe stocks. Pidilite is one stock which, again, been talking about it for last 3 months now. There was a buyback, and after that, just one-way rally on that stock. Fresh all-time high backed by delivery, of course, as we discussed, it closed at the high point. Hero MotoCorp is interesting. It's bounced back from 200-day moving average. It's outperforming both TVS and Bajaj, though underperforming Eicher Motors. Valuation-wise, it's the cheapest two-wheeler stock that we have. So that would be an interesting one to track.
Okay, well, I would think ICICI Bank should be on your radar. Over the weekend, there was reports, I think it was filed by PT, I saw all papers carried it, that SEBI is looking at a forensic examination of some of the financial statements and disclosures made by ICICI. And of course, they apparently are going to consult RBI to avoid regulatory overlap. More importantly, what were the disclosures made by Chanda Kochhar when she became MD? In 2009, even those would be. So a bit of continuing cloud on this stock can't be ruled out.
Okay, well, we'll keep an eye out on that. But more numbers. HDFC Bank came out with its numbers over the weekend. Another steady set this time, Abhishek?
Well, Sonia, it's very good to see the deposit growth, because what that does for the bank is that it improves the liquidity coverage ratio. So deposit growth was phenomenally strong, and especially on the low-cost deposit front also, which actually aided your cost of funds being under control. The fee income growth was phenomenal at 32% on a YY basis and 16% on a sequential basis. It was largely driven by retail portfolio, which grew by 28% on a YY basis. So loan growth was on the lower side because corporate portfolio didn't grow. Now, HDFC Bank always acts as a precursor to any growth in a sector. So if you have to take this into factor, is the best of profitable growth in corporate sector over for the banks will be seen in the coming times. Asset quality remains stable with gross NPA at 1.3%, and the slippage ratio, the annualized slippage ratio, was the lowest in last 5 quarters. So brokerages are fairly positive on HDFC Bank, with target price ranging between 22.50 to 25.15. However, only Kotak Securities remains worried of the fact that valuations are on the higher side. Back to you.
All right. Thank you very much for that. We'll, of course, revisit these numbers again and again. But Abhishek, you also had another big number that came over the weekend, Indiabulls Housing.
Well, Lata, loan growth is fairly on the higher side. If you look at the loan growth at 34% plus, it's the highest in 7 quarters, but it has come in at a cost. Why? The cost is not the cost of funds, but the yields. The yields have been declining, and the spreads at 3.11% is lower than the management's guidance of maintaining the spread between 3.2 to 3.25%. The asset quality remains stable, with gross NPA at 0.77% versus 0.77 sequentially. Brokerages have a mixed review, with 2 of them having buy, while 2 of them are worried of the fact of valuations that the company is commanding. Back to you.
Okay, Abhishek, thanks a lot for that. Lata, this crude, I mean, one thought that after the Trump tweet, it will at least come off a bit, but still somewhere around 74.
You know, it came off on Friday evening when I told you we were doing that discussion on current account deficit. I felt like a fool because suddenly it went down to $72 and then dramatically came back to 74. So I have a feeling that that will continue to pressure oil marketing companies and be obviously positive for ONGC and for companies like perhaps Aban.
Okay, well, demand has also been very strong, and that's been supporting the crude oil market. We'll keep an eye out on that. But moving on, let's talk about IT. The IT numbers have been coming in thick and fast. Rima, what did Sasken Communications do this quarter?
Well, largely mixed. There is a revenue decline, but the positive is that their margins are improving, and that is driving a significant growth in their profitability. So revenue is down 2.4% sequentially, but profits have gone up by more than 400 basis points quarter on quarter to 16.7%, and that is driving a that 27% Q-on-Q increase in the company's profits. So I'd go with green for Sasken Technology today.
Okay, green for Sasken. Ekta, what about Unichem?
Well, Unichem's Ghaziabad plant has been cleared by the US FTA with 0 observations. Hence, I expect the stock to be in the green today. Remember that this particular inspection which took place also covered one of their key drugs, and hence there will be that incremental positive which we could see on Unichem.
Okay, thanks for that. And Rima, back to you again. More news on Infosys, from Infosys. They'll be speaking to investors.
Yes, this is the first investor meet under the new CEO, Salil Parekh. It will be held in Mumbai today. The timing is 4 to 7:30, where the company will focus on its strategy as well as capital allocation. Now, in the press conference, Salil Parekh already outlined his strategy, which is based on 4 pillars. One is scaling up the digital portfolio. Secondly, energizing its core competency through artificial intelligence and automation. Thirdly, was reskilling his employees. And fourthly, localization. Basically, increase their on-site presence in markets like US, Europe, as well as Australia. I guess we'll get more color on all, his strategy in more detail.
Okay, thanks a lot for that. We'll watch out for that. Infosys was up quite a bit on Friday. But let's talk about some more stocks that are in the news this morning. Sonal is with us. Sonal, over to you.
I'll start with some results where CDSL came up with good set of numbers, the revenue growth of around 35%, but they could only clock 10% profit growth because of higher tax expense that came in at around 19% versus 7.5%. They also saw some higher employee expenses this quarter, which led to little lower profits in comparison to revenue. Sri Digvijay Cement, strong set of numbers, revenue was up 82% and also margins came in at 15.2% versus 7.1% last quarter. So that means should be green on the stock. Shiva Cements reported a weak set of numbers. Revenue went up by 1.2 times. Profits also went up to 2 crores versus a loss last year. But they reported an EBITDA loss. Also, the profits were higher because profits this quarter saw a tax write-back of around 6.5 crores. Expect that stock to be in red today. Indian Hume Pipe has bagged a work order of 578 crores from MP Jal Nigam. Expect that stock to be in green. And also, Federal Bank will be in focus because there are reports that True North is in talks to buy 26% stake in the NBFC for 400 crores, but these are just reports and CNBC TV18 has not independently verified them.
Okay, guys, thanks a lot for that. We also have a lot of NBFCs coming out with their numbers today. LIC Housing, Chola Mandalam, Bharat Financial. We'll talk about that in detail as well. But here's a quick recap in case you missed out on our top 10 stocks. Expected to gain today are names like Pidilite, Hero MotoCorp, HDFC Bank, Indiabulls Housing, ONGC, Aban Offshore, Dolphin Offshore, Sasken Communications, Unichem, CDSL, Sri Digvijay Cement, Indian Hume Pipes, Federal Bank and Infosys. While stocks that could be under pressure today, ICICI Bank because of those reports on the SEBI move there, BPCL, HPCL, IOC, Jet Airways, Interglobe Aviation, SpiceJet because of Crude, Asian Paints, Kansai Nerolac, Berger Paints and Shiva Cements.
All right. And now back to analyzing crude. Crude oil prices have dipped in early trade, but overall the sentiment remains bullish even after that all-important President Trump tweet saying he doesn't like the way Saudi Arabia is keeping oil prices higher. David Lennox of Fat Profits joins us for a quick check on how this market might move from here on. Good morning, David. What looked like a scare from President Trump was shrugged off by the oil market. What is the trend you're seeing now? Is 74 here to stay?
Oh, look, certainly if you have a look at the factors impacting on the Brent price, you'd have to suggest that, yes, we're going to see a consistently higher Brent price than we've seen over the course of the first few months of 2018. Yes, that President Trump tweet was probably looking to perhaps have more of an impact on the pricing than it did. We do think, however, if you have a look at the downsides, it would appear as though the Russian-Saudi alliance is now perhaps starting to fray, with the Saudis suggesting that they will continue to support the 32.5 million ceiling, while in fact the Russians look as though they're looking over their shoulder at US domestic production, and they're suggesting that they won't be supportive of any further cuts. So this is the first time we've seen that alliance perhaps starting to fray, so markets are going to watch that very closely, and I suspect that we'll just see some of the premium coming out of the Brent price in the near term as markets do digest that particular move. Overall, you're right, we do think we're in a strong period for the oil price. We do believe that OPEC will continue to comply with the 32.5 million ceiling. There may be some movement of the deck chairs around who produces how much, and we will see ups and downs there, but certainly that compliance will remain in place. And we, of course, are looking over our shoulders at domestic production inside the US, which now sits at 10.5, trend upwards over the course of this year. And we think if we're right and Brent prices and WTI prices stay high, then that trend's just going to continue up on the over the rest of this year.
But David, the OPEC did also say that, you know, the global oil glut situation has been virtually eliminated, right? Don't you think that would result in a bit more balanced demand-supply situation and a cap on crude?
Oh, look, certainly if we do see that continue to manifest itself, the deficit, we would expect to see the oil price to rise. However, markets do remain very concerned about, as I've just suggested, the alliance between Russia and the Saudis now perhaps fraying, and that could put into question that 32.5 million ceiling that OPEC has been compliant with. We're all very used to OPEC not living up to what its promises, so markets will be watching that very closely, and that's why we haven't seen that further rally in the oil price that one would have expected. It's just that a concern that OPEC may be fraying. And that's all because of a couple of things. What will Donald Trump be able to do to drive the oil prices lower if he does consider them too high? That's not quite plain to see. He could perhaps encourage further domestic production inside the US, so we'd be watching very closely there. So really at this point, the market's just probably resting on the fact that we will see compliance and we will see those oil prices remain robust over the course of the next few weeks.
Just put a number to robust. Are we likely to see south of 75 or north of $75?
Latha, look, we expect our end-of-year price of $74 to $84 for Brent to remain in place. We don't think that that will be breached. So one would suggest that the upside is somewhat limited to perhaps where it stands to around that $10. So if there is concern, it's going to be a downward concern, and that could see the Brent price slipping back towards that high 60s where we have seen it trading for some time.
If it's at 74 or it tops at 74, then I think we'll be happy to hear that, because there were suggestions, reports suggesting that Saudi Arabia is happy with even $100 a barrel, suggesting that, you know, perhaps Riyadh may not see any changes to their pact anytime soon. And if that comes through, then it's going to be something that India is definitely going to worry about. But David, thanks so much for stopping by and speaking to us, giving us your thoughts as well. That's the word coming in on crude. So tops, he sees about $74, $75 a